I absolutely hate third-party management.
Mm.
They are not your friend. They are there to make sure that heads are in beds. They're make sure that they get paid first, but they could give a rat's ass about what expenses it took to put that head into a bed.
They almost are incentivized, or they have an alignment of interest to have not renewals, but move outs and then new lease ups, right?
Yeah, because they use their vendors. There are kickbacks with those vendors. They come in the form of tickets to a game. They come in the form of actual rebates back to the property management company. There's a lot of hidden ways. The third-party manager will also pass along their internal overhead. I went through 3 different maintenance regionals, lead maintenance regionals. We went through 3 controllers. We went through a variety of just like, what the fuck? If you're so big, why do you have this turnover? Why can't you keep people employed? You're paying through the fucking nose. I'm paying through the nose. So what I saw was a monster increase in my expenses. And this is a lesson for everybody out there. Don't think that they know more than you. And here's how I'm going to tell you that. If you can sign on the dotted line, if you can go and have the wherewithal to get to that point, why do you think they're smarter than you? You're the one that put millions of dollars on the line. You're the one that raised all the equity. You're the one that put it all together. But yet you're going to give your future to somebody else's hands who have never done that.
All right, guys, welcome to another episode of The Report. Today, we are out here in Houston, Texas at the Rockstar Capital headquarters, and I got my man, Mr. Robert Martinez. Robert, welcome to the show.
Man, thanks so much, Rich. I'm a big fan. You've had some of the biggest players on your show in a short amount of time.
Yeah, man, it's been super fun, and I'm excited to be out here, dude. It's cool to check out your whole operation out here. I got a chance to meet your team this morning.
Yeah.
A lot of big players and good energy out here. So
is this the first property management, asset management combo you've seen?
Yeah, man. So I would say out of all the different spots I've visited, yours is the first. That's kind of the property management and the real estate investing combo. I will say out in San Diego in our studio, our office, we have similar thing. But we manage not multifamily, we manage short-term rentals and boutique hotels.
Yep.
And we're buying boutique hotels as well. But dude, it's an honor to be here. So thank you.
Thank you, man. Everybody talks about being vertically integrated. That's like the big phrase, right? But I've been doing this for 15 years. I've always done my property management in-house. So today we have 130 employees, just under 4,600 units. So having an asset team, having marketing, having our operations, having sales, having all together under one roof has been a very common for us for a long time.
Yeah, absolutely. So, I want to jump right into it. There's a lot of talk with the high interest rate environment. Yeah. The Fed's got all the control right now with the interest rates. And we're starting to see some operators, that weren't able to increase their NOI get into positions with the floating rate debt, myself included. I got into a couple multifamily deals early 21. All the smart money was doing the floating rate debt, Fannie, Freddie, 1% prepayment penalty. We never thought the interest rate environment would be where it's at today. Get the interest rate caps. And so it's going to be interesting to kind of see how this plays out over the next 6 to 12 months. I know there was an article recently on The Real Deal. You guys are foreclosing on a $51 million multifamily loan and a lot of talk out there, but I want to hear from the man.
Yeah.
I want to hear your perspective. What happened there?
Yeah. So, I've been doing this for a long time. Since 2007 was when I bought my first deal. So I saw the last recession and never has there been a spike in interest rates the way this is. So as we're building out of the recession, we're going into it. Yeah, there's a lot of hunger. There's a lot of excitement. People are trying to make deals work. People are trying to use debt funds come around and they start to help deals pen out on the underwriting instead of using the traditional fixed rate. Rates were down for a long time. And I don't care who you are. Nobody predicted this. Nobody had a crystal ball. Nobody said, oh, you should have known better. Everybody's doing it. The biggest players were doing it. Blackstone, BlackRock, right? All those guys. You're seeing foreclosures done every day, especially in the office space, right? They're just getting absolutely killed. So what happened on my deal was, again, I've got a great track record. I've got 100% cashed out events. But because of what happened, I have 9 deals at risk. And I put 2 of them to bed. I put them to bed at the beginning of the year, and I was trying to get this one worked out. I've got, 6 more, and 4 of those should be lined up for refi in the next 90 days. So I'm super excited about that, right? But this deal literally got bought the day before the very first interest rate hike. How could you plan for that? There was, we had a rate cap, of course, but there was no interest reserve. It was unnecessary for a deal.
What was the rate cap on that one?
Oh, gosh.
200 basis points?
Yeah, it was about 225, something like that. Okay. It wasn't the end of the world. And rate caps were a very new thing. I didn't have my very first rate cap until August of 21 on a deal. And I'm like, what's this? I thought it was just another closing statement checklist. It was $40,000 for the protection. Thank God I got it, right? I wound up, when we refinanced that deal, I wound up selling it for well over $1 million. Helped us with our refinance and the proceeds, so we didn't have as much cash in and all that. But this is a resetting in the market. And so on that particular deal, it was a perfect storm of events. So not only did we see all of the 11 rate hikes, Houston, or Texas South Coast, Southwest, got hit with a massive increase in property taxes. So at the same time, we're paying, I don't know, what was it, $700 a door for our property insurance. It jumped to like $1,600 a door. If you know guys in Florida, they got even higher than that. I mean, every disaster just came home to roost. So that destroyed our NOI. That ate up our immediate reserves. Then it was the first time that I've ever had to finance my property insurance premium. And so we're having to make payments on this. At the same time, the lender now knows, hey, your new property insurance is this, right? So guess what? They're going to escrow this much more out. So that destroys cash flow. So it was a ticking time bomb, taxes, whatever, we experienced some interesting, are you familiar with Airbnb? Are you pretty big into it?
Yeah, we operate a lot of Airbnb stuff, boutique hotels in 10 markets around the country right now.
Do you use any in apartment complexes?
No.
Yeah. So
I won't.
Yeah. Well, what happened was we took over property, and while we did our due diligence, my team, and I don't know how anybody could have seen it, they didn't see the Airbnb that were filtered through the entire complex. We're right next to NRG Stadium where the Texans play, where we have the Houston Livestock Show.
These are your tenants that are doing the Airbnb?
Yeah.
Or you guys were going to operate?
No, they were doing it.
Ah.
And so we didn't see it. They didn't know what to look for.
Got it.
When you scale, you teach your team how to do things. But then in time, people leave.
Mm-hmm.
I know we covered this, but the people that I covered it with just weren't around anymore. So others were walking this deal. And again, I take full responsibility. I don't blame anybody on this. And we missed the Airbnb component. That brought in an element of crime because they were just Airbnb to anybody. I mean, I literally hate Airbnb. And I couldn't track them. But if you go to Airbnb website, you can see that they're all there, in the apartment building. So they cause crime. They cause renewal issues. They cause a lot of things. At the same time, my debt's going up. We had a plan. I told the investors early on, hey, I'll say beginning of the year, we're going to struggle this year. We're going to have to do some sort of cash call at some point. Let me get the details out. I kept them in the loop. We went to weekly updates on top of our monthly updates. And I hired a workout consultant. And I was really happy that The Real Deal contacted me and gave me a chance because they just did a deal on somebody that I know up in Dallas. And they absolutely obliterated him. I don't know if you read that article, but I feel really bad. But he didn't want to work with him clearly. They had a spokesman. No, I took it right there up front and I told my side of the story. So what happened was we hired a workout specialist, just like you see in the movie Too Big to Fail. And they're there to work with the lender. So you pay a fee there. That was about $100,000 plus another $15,000.
So real quick, there's a Freddie floater.
It's a Freddie floater.
And you were working with the servicer.
Yeah.
Okay, who was the servicer, if you can say?
I prefer not to.
Okay.
Well, yeah, it's public record. It's the servicer. Well, it was CBRE, and then it was MF1 was the lender.
Okay, MF1, got it.
And we worked with them. I tried to follow all the right channels. We're running out of cash. The lender made it very clear that if you want to negotiate, don't miss any payments. And so, of course, there was no more money left. And before I can go to the investors and say, here's our plan, I need to know what the plan is. So I floated it myself. So I have $700,000 in the deal. When it's all said and done, I have to go another 2 months of finally getting a decision with the lender. So I'm out roughly another $858,000. So before anybody took it on the chin, I took it on the chin first. I want to make sure I have a plan. We asked for deferred interest, a cut in the rates, any kind of assistance to bring the monthly nut down. At the end of the day, the lender said no. The lender said no. And then at the end, so I'm like, okay, so are we going to save this deal? Went back to the investor. I go, listen, we can save this deal, but like anything in real estate, you only lose when you run out of time or you run out of money. We're not going to hit our projections anymore. The Fed took care of that. They took care of everybody's projections from 21, 22. But we can keep the deal alive. We can make our money back and probably make a profit, but we're going to have to hold it for the better part of 7 to 10 years. So I went
And
back
a lot of that would be contingent on when the Fed reduces rates as well.
Yes, because you're going to have to continue to buy a rate cap if they don't. See, that's the thing. People don't know if the Fed's ever going to
size it up to refi into fixed rate debt? Because I know we did that with a couple deals, but like you didn't see the NOI growth in order to do that. Is that right? So you would have brought cash in to refi into the fixed?
Yes. That's it. Everybody, I don't care. The equity's gone. Everybody's equity is gone.
It's a catch-22 because, it's like, okay, well, let's refi into the fixed rate debt. You probably got in, 2.5 around there. Mm-hmm. And then now you refi a fixed rate debt, 5.5, 5.75. Well, now you got the yield maintenance, prepay and all that. And what if the rates go back down in 18 months and now you're like stuck again? So it's kind of a catch-22.
It is. It is.
So some operators, like I had Grant on the podcast, he said he bought $1 billion multifamily portfolio in December of 21 on floating rate debt.
Yeah.
And he's like, dude, we're not, he's like, I'm floating this with my own money right now. We're not doing distributions, but he's like, I'm just going to wait for the rates to go back down. So we'll see. But dude, that can't be expensive, or they can't be cheap. That's for sure. And so, dude, I get it.
Any good operator that's been doing this long enough will take that responsibility because you're the man sitting in the chair.
You have to.
That's why I didn't go raise any additional money. I didn't take any on. I needed to take it on the chin myself. Mm-hmm. And so I had a plan. And so when we realized that the lender was not going to work with us, we had to go back to the investor. Okay, hey, here's the plan. Lender's not going to work with us. The equity's gone. Here's what it's worth. It's below loan value. Now, we can kick the can down the road. We can inject further capital. We can play for a better day. But when is that better day? I don't know. I can give you a pro forma. I can say in 5 years, we're going to be at this number, but we're going to need help. I can come to you and piecemeal it along the way, or I can get you some money right now. We can raise all of our cash together. We can figure out a plan. So one of the problems I didn't mention was I went to third-party management at the same time that I'm going through this. I was just at a point in the business where we had some turnover, and I'm like, okay, maybe this is the time to go get a big player. So I actually used, as a recommendation, this third-party management from somebody who swears by them.
And question for you. So up until this point, you were vertically integrated.
Always.
You guys self-manage all your stuff.
Always.
And what was the inflection point to pivot back to third party?
Well, I went there thinking that it's labor is a shortage. And when you're with a big management company, they offer certain bennies. They offer a lot of things, right? But remember, where are they coming from? They're coming from your pocket, right? I thought that they could help them fix accounting, make accounting flow better, get better costs of, get economies of scale, get costs down. Everything that I wanted to hope happen did not happen. Now, maybe it's because I'm too good at this. Maybe because I'm a 2-time national over the year and you can't bullshit me anymore. I can see through things. What I did not anticipate is that none of those things played out. We dramatically increased contract services, staffing help, because they can never keep people in the chair on any of my portfolio. Accounting went horribly wrong. As I now have taken it back, we're still paying bills from 6 months ago that the management company never paid.
So you brought it back in-house.
I had to bring it back in-house because it was knowing where we're at, it was the only way my portfolio would succeed if I could bring in my expense model. And this is a very key point. So when I went back to the lender, I go, okay, great. Here's what we're going to do. We're going to send you the rate cap that it's going to be due in March. I'm going to give it to you right now. I'm going to give you the next 12 months reserves to cover you as well. So you're protected, right? Because if we foreclose and we saw this, I don't know what the deal is going to be. Right now, you keep me. I'm the original sponsor. I'll keep a little bit of cash internally and we'll run it. Everything was great. The day before that we're supposed to execute all this, because I had all the commitments. I had 60, 70% of the money raised in my pocket, or not in my pocket, but in the bank accounts, ready to go with this. Whatever I was going to short, I'm going to pre-fund out of my own pocket. I'm going to leave my personal loan in the deal, and I'll wait for it another day in the future. The lender comes back to me and says, hey, listen, we need the third-party manager back. And I'm like, what do you mean you need the third-party manager back? Well, they want them, not you. And I told them, you understand, right? Because of the situation of the deal, that we want them, not you. And I said, you understand that they're a big reason why we're in this situation. Yep. My expenses just got ballooned. I go, look what I've already done. I've already had it back for 30 days. I've cut contract services to zero. I had a fully staffed office the day we took over. I brought my own in-house recruiter in, filled it up. I don't know why they couldn't fill me up, but they couldn't. So we cut all the staffing. We started doing everything in-house. No more, hiring now for paint, no hiring now for whatever service. Brought OT down by more than 50%. I go, look at what I've done. Look at the NOI after just 1 month. I know, but we need the other guy back. And I said to the guy, I go, bro, if you push this and make me do this, I cannot in good faith put my investors' money, because it literally would be good money after bad. It's already a little bit of a stretch, right? I'm going to have to play this out for the next several years, but I can do it. I'm going to die on this hill because I'm not going to give this point up. Are you sure this is what you want to do? And they're like, yeah.
Wow. That's crazy. So tell me about this asset. Like what was is this a B-class asset?
No, it was brand new. It was a 2018
so
construction.
Class A.
Yeah.
And it was stabilized when you bought it?
It was stabilized when I bought it.
Did it have a value add component going in?
Minimal. Yeah.
Well,
we're going to do tech. We're going to do some other things like that. We were going to do little improvements that operators do. I saw they had a lot of contract services. We were going to cut that out. We were going to do everything in-house. And we started to do that for a while. But that Airbnb component kept beating us up. As we lease apartments, everybody's moving out. Mm-hmm. And anybody who's been doing this understands you make your money when people renew, not when they move in. Mm-hmm. And so people were not renewing. So our expenses were never going down.
What percentage of those units were leased out via Airbnb? If you are a busy professional and don't have time to invest in real estate, but still want to participate in the passive income and tax benefits, my team, Summers Capital, is buying a lot of boutique hotels right now. We source the deals, we renovate the properties, and we even do all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, go to summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show.
I say 30 plus.
Wow, that high.
I think
you guys didn't see that in due diligence?
No, that's what I'm trying to say. I think the previous owner covered it up because it was there. It was there. And, there's a lot of people that do corporate housing. And we're in the medical center. So corporate housing is a big number, right? People are staying there temporarily so they can go to MD Anderson, world-class facility here in Houston for cancer therapy. And then, of course, you have all the big events that happen at NRG. So there is a huge attraction to Airbnb. I never saw the negative side to it, how you would have this crime components that would come to it. As we would drive and walk around the properties at night, there'd be all doors kind of open because they don't have the magnetic key to get in. So that was just going on over and over, no matter how much time we tried to get out. So it took time before we finally evicted enough of them.
And that was probably rubbing the long-term tenants the wrong way too, right?
Well, it caused crime. Yeah. It caused vandalism. It caused issues in the garage. That's what I'm trying to say. They didn't want to renew because of the crime that was present. How the other company kept it quiet, I don't know.
How low did your occupancy drop?
High 70s. And then we built it back up when I think we had a low of upper 70s in January. When the lender took it back, we were at 90 plus. I mean, we were on our way. We were doing everything our plan. We had hit better numbers then than at any point in the 10 months that the management company had. So it was very, very disheartening, to do that. And when you raise $18 million of people's cash on top of your own money, it's a very personal, it's a very big deal. And look, they are all big boys and girls. They're all credited investors, but it still hurts.
And you did 15 deals in the green, and then this one. How many of those investors have done previous deals with
66%.
Okay. Got it. And how did they handle it? What was the general reception?
Overall, it was well. I feel bad for the new ones that haven't had a chance to be, to play in the game with me over the last 10, 15 years as I've built my portfolio.
How did you break the news? Did you call like an in-person meeting?
Yeah, of course. So there was we already do a lot of weekly meetings, and then we do a monthly wrap up. And as we got into this stage where I'm now putting my money into the deal, I want them to know what I'm doing. I need to control the narrative. I don't care what you saw on social media. I don't care what anybody was saying. My investors know what I did for them. My investors, this was a very private, internal matter that people just want to run with it. I always want to be in the real deal for something good.
Sure.
Right. But they like to promote the bad. And that's just journalism.
That's what gets
today.
The clicks.
That's what gets the clicks. The thing is, I was very happy they at least contacted me, gave me a chance to respond, because I can see what they've done to grants and I can see what they've done to others. And they just try to do their best to obliterate them. I want to go into it. I knew the house was on fire. I'm trying to put it out myself. And when I realized that we're going to have issues, we definitely increased it. So we had a big call, and they knew we were raising the money. They knew it was all going down. And I said, listen, we have to have a final update. And I put that on the message, when we did our webinar and Scott was around, it was hard, but I know it wasn't just breaking the news. See, what happens is a lot of guys will run from this. They don't know what to do. They literally are in the corner of the closet in the fetal position. I know that because early on I was one of them. I didn't know what was going on. You probably, if you got deals in 21, you saw the race. I like, it can't go up much higher. It can't go up much higher. And it just kept moving and moving to where we know, holy shit, we have no control what's going to go on here.
Yeah.
And
the only thing that saved us is we bought C-class deals that had a lot of value add potential. Yeah. And so we were able to increase the rents by 25, 30%. Yeah. And we were able to increase the NOI just enough to be able to refinance a fixed debt. But had we not been able to do that, we would have been in the same position. And Absolutely. I know there's a lot of other operators right now that are in that very same position that you were. It just hasn't surfaced yet.
Those guys that have Class A deals that didn't have enough runway, right? Because you only lose these deals when you're out of time and money. Something's got to give. If you can hold them for 10 years, you'll make your money. And that was our plan. Hold it for 10 years, but you got to keep feeding it. What will it be worth? Do you think it'll be worth more in 10 years than now? Yeah, I think we all agree.
Yeah.
But we got to keep having the fortitude to feed it, right? It takes a lot. As you mentioned, Grant, he's got deals. He's talked about it openly, so we're not saying.
And he was buying a lot of Class A over the last few years.
Do the math. He's having to feed these deals, right? Because he cannot afford to let a deal down. I did not expect to lose this deal. We had the money raised. The investors were all ready to go. We got the rug pulled from us. And at that point, I'm like, why am I going to go into a situation that I know is not going to work? We're going to lose the money that I've raised and we'll be in the same spot in less than a year. Nothing is going to get better. I absolutely hate third-party management. I absolutely despise it. They are not your friend. They are there to make sure that heads are in beds. They're make sure that they get paid first, but they could give a rat's ass about what expenses it took to put that head into a bed.
They almost are incentivized, or they have an alignment of interest to have not renewals, but move outs and then new lease ups, right?
Yeah, because they use their vendors. There are kickbacks with those vendors. They come in the form of tickets to a game. They come in the form of actual rebates back to the property management company. There's a lot of hidden ways. The third-party manager will also pass along their internal overhead. We had, in my time with my third-party management company, I went through 3 different regionals. I went through 3 different maintenance regionals, lead maintenance regionals. We went through 3 controllers. We went through a variety of just like, what the fuck? If you're so big, why do you have this turnover? Why can't you keep people employed? You're paying through the fucking nose. I'm paying through the nose. So what I saw was a monster increase in my expenses. And this is a lesson for everybody out there. Don't think that they know more than you. And here's how I'm going to tell you that. If you can sign on the dotted line, if you can go and have the wherewithal to get to that point, why do you think they're smarter than you? You're the one that put millions of dollars on the line. You're the one that raised all the equity. You're the ones that you're the one that put it all together, but yet you're going to give your future to somebody else's hands who have never done that.
And I think, like, to your point, with every real estate deal we do, there's always things that we overlook. But when we are vertically integrated, it gives me the confidence to know, like, when shit hits the fan, like, we're going to figure it out because we have full control. And when you're relying on third party, I don't care who they are. It's like, you're never really going to be able to sleep good at night.
No, because you don't have control. See, they have HR. They have shit that they have to deal with. I don't. I am HR. Rich and I got a problem. We're going to hammer it out. And then I'm going to pat them on the ass and we're going to get going. If I see 2 of my staff, I'm going to bring them in. What's up? Okay, what's your side? Okay, both of you are like wrong because that's what happens. Here's what I see, which is the truth. Right? This is how we're going to handle it. Can y'all get along or does one of y'all have to leave? Because this is the last time we're going to have this convo. That's HR. That's not sit here and babying you. Oh, are your feelings okay? I'm the most anti-woke guy there is. Like, I don't need feelings. I need production. This is a real situation right now. And see, to think that the management company is going to act this way is not, because their balls are on the line. When you sign on that floating rate debt, your balls on their line. The balls of the investors that you put equity into those deals with you are on the line. The management company, they're the last one to respond. Everything went wrong when I went there. It was probably the greatest mistake that I've made. The best thing I did was bring it back. So I now saw, hey, I would never again think that they're better than me. And I should have trusted all those 19 city, state, national apartment association awards that are in the lobby, including being a 2-time national owner of the year, to trust myself that I know better than they do. Because if they were better than me, they'd be sitting in this chair. They would have the $600 million portfolio instead of working for somebody else.
Yeah, I agree. So with the 4,500 units you have, outsourcing, going from in-house property management to third party, and then 6 months later, bringing it back in-house. I mean, that's got to be a hell of a transition. Talk about that.
Yeah, I'm great. Thanks. No one's asked me that question yet. I would not be here where I'm at today if I hadn't already been through this. This is now my 3rd time starting a management company. I did it back in 2007 with my old partner. I did it when I started Rockstar in 2011. Now this is the 3rd time. So what happens is, you get better at this. You know what works, what doesn't work. Every one of those gray hairs is the lesson, right? I don't need this. I don't need HR. I am HR. Oh, I'm going to be a big company. I'm going to have HR in the building. No, dude. HR doesn't protect anybody. They make mistakes. So if you get an HR person in there, you better hope that you're aligned with them. You learn social media. You learn how to cut costs in-house. When I started in the business, I sat in the leasing chair. I walked away from many people don't do this. I actually walked away from my day job and I pursued this full time. And I sat there in the leasing chair and I learned how to lease apartments. I learned how to knock on rent, which means I got lied to. I learned how to walk make-readies. I learned to understand how these work and how much time. I learned the KPIs of the business. Nobody can bullshit me because these are my KPIs. Bringing it back in-house allows me to fast forward. I wrote down the list. Okay, I need these items. Boom, 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 boom. And if you're a really good operator, if you got a good track record of just being a good business owner, when people hear you're back in charge, they want to come work with you again. So people from my past heard that I was putting the band back together, and they say, "Hey, I want in. I only left because you were seeing like you were getting out of the business. Somebody became my superior, and they didn't do it your way. They wanted to do it their way. So we never got along."
Did a lot of the people on payroll at these apartments, the leasing agents, maintenance, those folks stayed in place? And you just brought in new management to oversee those folks.
I'm glad you asked that. So when I took over the business, I had 35 open positions. That's a lot.
And what were the majority of those positions?
I mean, everything from property manager, assistant manager, and maintenance. Every open position with the on-site team was affected. So I brought an in-house recruiter in, and for 30 days before we took over, he's burning up the phones. He's a guy that worked at a staffing company. So he had this experience staffing for apartment positions. So he knew what we were looking for. And we're making job offers. Boom, boom, boom. So when we took over, within 30 days, we have filled every position. Now, understand, great. But the other people that are there that we inherited, I didn't hire a bunch of them. They were hired by the third-party management company, which who knows where they got them. Are they qualified? So now that we've got everything back to 100%, I'm now filtering through. We've probably, of those 35 we've hired, we've probably already had 50% turnover because I've had to go and get rid of other people that were in the business. Right now, I think we probably have, 4 or 5 open positions, which is great. But you come into like, I'm culling the herd. You're too weak. You can't work with us. I'm not going to I have to do something. Let me give you a quick example. 2 weeks ago, I make sure that everybody that hires comes here and gets training. I don't throw anybody out to the deep end of the pool. So whether it's a leasing agent, property manager, they're coming in. And I come in and I watch the training and I say hi and introduce them. And I set the standard of expectation. So I'm watching. There's this one girl, very, very cute girl, perfect for the leasing agent position. I'm checking with her. She's okay. She's getting it. She's with a property manager who's going to be taking over for one of our other sites. Much more experience, just here because, she needs to learn our processes.
Sure.
I'm like, okay, great. 3rd day comes around. The cute girl calls in and says, "Hey, I just learned so much the last 2 days. I need a mental health day." And they called me. I was actually at the gym. They called me at 9:15 in the morning, told me the story. I said, okay, well, I guess she said she's going to come in this weekend and she'll work on next week. No, she's not. She's going to go work that for somebody else. She's done with us. Because if you can't keep your shit together for the first 3 days to a month, then you got a problem. And what does that say to the other woman who was in the office, who it's her 3rd day and she's out doing what she's supposed to be doing? See, that was the day they were supposed to go shop their comps. 2 days of in-house training, third day of checking out your comps, and then shopping your own property because they don't know you to see what you're walking into. So she couldn't hear. So when I asked her, check this out. When I asked her, hey, what's the real story? Why did she not show up? Well, I think she was worried about losing the deposit on her eyelashes because she had an appointment scheduled the next day. It was $150.
I mean, it's like the first impression's everything, whether it's a new position, a new job, or whether it's a new relationship or dating. So, people typically, when you date a new person, they're going to be on their best behavior the first month. And so if you can't get past that first week, then that's a sign of what's to come,
I love that you use the dating expressions. I use those all the time. You know, Scott, I always use relationship, right? Yeah, let's take a step further. What are my standards? What are my boundaries? You've crossed my boundaries. That's a red flag for me. I don't care how cute you are. If you already crossed my boundaries, what's going to happen later when you're more comfortable with me? And what does it say to everybody else that you're okay with it? See, I need to build Navy SEALs here, not baby SEALs. That is the kind of person that would have been allowed to come in with a third-party management company that is not here today because I need somebody stronger. I set the tone. And you know what I like to do? I like to do public executions. So this story, I share it to you. We have a weekly Wednesday meeting with all the sub-managers. I share with them that story. I want them to know why somebody's not here anymore. I also rank all my properties from 1 to 23, and they're cut up by thirds. The bottom third will drive any company's business, any business. You can only go as far as that bottom third.
You will only grow to the level of your constraints,
that's right,
not your potential. Hey guys, real quick, the only way this podcast grows is if you guys share it and review the show. So if you do find value, if you could take 2 seconds and drop a 5-star on Spotify or Apple Podcasts, it would mean the world to me. But more importantly, it will help us reach new audiences and help more people build wealth through real estate investing.
So I'm at 91% as a portfolio. There's 3 of the 8 that are at 90. The rest are in the 80s. And so I've made changes throughout those 8. And I tell everybody there, it's okay to be here. Just have some sort of upward momentum. If I can get everybody down here to be at 90, I'm going to feel pretty good, right? But if you're in the 80s, know that I'm going to spotlight you. Yeah. And I'm going to watch your numbers. My asset guys who I've trained and hired personally are watching them for me, with me. We have weekly, daily meetings. And if you stay there too long, I'm going to move you out. So I'm very honest and open up front. And I'm like, hey, you've been hanging out there too long. And I'm saying this in the entire Zoom call. They're all listening. What are they doing? They're watching. They see it. So if you have something inside of you, you're going to pull yourself out of it. And so what happens is when somebody leaves, I make sure I let everybody know, hey, FYI, you know that Suzy Q has been number 23 for a long time. And we have a lot of faith in her, and it just didn't play out. So we wished her well, and we ended her employment with us yesterday. We're now moving somebody over. See, you've got to set the example with everybody. So I love public executions. I come in looking to get rid of somebody every single day, every single week, because that's the only way you're going to get better. These are not my people. These are still somebody else's people. They will not be my people until a year. You know why a year? Because that's when the renewal is, right? In your apartment buildings, when you take over, right? You have to have responsibility for them. But really, if you don't want them, you get rid of them in a year. You've gotten rid of everybody you want to get rid of. So everybody here is on a 90-day probation. If you make it past 90 days, you're doing well. If you make it to a year, now you're my people. Now you're people that Robert approved. That's why I want everybody coming through here. I want to see you. I want to see how you act. And I want to make sure that you're representative of what I'm trying to build on site. And that's how you win all those awards. And that's how you get back to doing that. So right now, we're learning how to put our socks and shoes on again and learning how to play basketball. We're going back to basics. And so every one of these Wednesday calls, it is back to basics. I've come up with all these different, again, we talk about how do you do this? I've learned now, okay, I need to have a lot of pictures. I need to have more processes. I need them to measure. These are the 2 things we need. We have a triangle called the pyramid of success: leasing, collections, renewals. In the center is service. We have our whole process that comes in from the time that we find them on Google to how we bring them in.
I got to say this about my man, Robert, though. For someone that went away from the in-house to third party, you are fucking excited about this property management.
This is passionate,
you are
right?
passionate.
You know, I know you talk.
I'm shocked you let it go.
You know, I had a low point where everybody, like, what happened was in 2020, I had some turnover of some very key people. And when they left, I brought other people in. And of course, you always got to bring the executives. You trust those C-suite guys. And then, oh crap, you got to make another change. And I think what happened, they brought in so many people that I didn't recognize my business. And you know what? Maybe this is a sign from God. But what happened was it was a recharge, a recheck for me. And now I realize this is who I'm supposed to be. And if anything, I'm even more passionate than I ever have been. You know, you probably talk to a lot of guys. Nobody will talk operations with you the way I can because nobody sat in that chair as long as I did. You know, I love Grant. Grant's one of my mentors, you know, but Grant's about equity raising and moving on to the next deal. He's not going to share with you KPIs because he doesn't know them. He never sat in that chair, right? So you've got to have that guy. Who you're going to put your money with. And that's how I feel.
Absolutely. So I want to switch gears here a little bit and talk about what's going on in the market. Here locally in Houston, what are you guys seeing with rent growth and occupancy?
It's a national problem. It's slowing down. You know, our big booms are spring and then the summer. And we are behind on lease rent, right? Their Fed is pushing us into a recession. That is the whole design of raising the rates up. Now, you can go to the restaurants and you can still see people there, but are you going to the restaurants where the masters are going, or are you going to the restaurants where Rich Summers likes to go, right? You got to like come down a little bit and go to those other second, third tier restaurants. I'm like, okay, how's their activity? Where they're at? You know, how are they going? So I think we're going to see slowdown. You know, what is it today? Today's October 10th, 11th. We just had this issue with Israel and Palestine. Oil pricing is going to go up. What does that do to the economy? What does that do nationally? That's going to hurt it. Now, Houston's where all the oil's at. Dallas, where all the money's at. Finance, Bank of America, Chase. Houston's where the oil's at. So we will be okay. See, Houston in every recession is the last one to go in, but the first one to come out. And because of energy.
Now, what about from the supply standpoint out here in Houston?
Man,
Have there been a lot of new supply?
I love it. There's
online?
not very little. There's very little supply. Now, Austin, whole other story.
Yeah.
Whole other story.
Cap rates in Austin for a while were lower than New York City.
Sure.
That's crazy.
Sure.
Or if you look at where Austin was 10 years ago to where it was in the last couple of years, it's crazy. So Houston, you're saying there wasn't a ton of new development.
Well, there hasn't been, right? Because you've had all these different issues now. There is not a lot of supply right
That's
there.
good then.
So
good
for
you
any,
guys.
and I've seen this because I was around the last recession. When the recession kills supply, you have this huge demand for housing because the housing doesn't go away. Rents will come up. And if you own multifamily, it's going to be worth more because remember, your property is worth, it's all based on the rents. Properties are $110,000, $120,000 a door today because the rents are $1,000, $1,200. Back when I got started, rents were $600. So you're buying deals at $40,000, $50,000 easy. My first deal was $18,000 a door.
Wow. So take me back a little bit, man. What were you doing before real estate?
Yeah.
And then what kind of got you into it?
See, I don't care who you are. Nobody knows real estate coming out of the womb. Not unless you're Donald Trump Jr. or someone like that, where your daddy and your grandpa were in real estate. Most of us were doing something else. So my parents were my first mentors. They said, go to school, get good grades. So I did. I went to A&M. I have an engineering degree. And of course, those professors encourage you to go out into the workforce. So I didn't have a 3.0. My boys, I went to a college tour with him and he's got great. He's got like a 3.9. I wasn't that guy in college. I was the guy with a two something. So, but I had an engineering degree. So those guys go into sales. The 4.0s go into the think tanks and the little cubies. They're not me. I know just enough to be dangerous and I can wine and dine and get to know you. And, you know, we're going to be doing our little shakes and I'm going to get you to buy my product. And I'm going to, again, know enough just to get you to explain life cycle costs and our benefit analysis and what have you. And I did that for a period of time. And as any good sales guy, you want to get paid as much as you can. So you sell more, you expect to get paid more. After 3 times of my employer cutting my commission, I realized I didn't have control. And so I began to look around at other things. And I found a real estate club here in Houston. They've been around for 30 years at the time. Crazy loudmouth guy on the radio. After about a year of hearing him on the radio, as I'm making my sales calls, right, I'm listening to business radio, I show up to an event. I'm like, wow, this is cool. It's a free Thursday cocktail thing. I pay $500. I go to the 2-day on the weekend. I discover single family houses. I'm like, man, I'm going to be the single family king. I'm going to do this. I show up Sunday. I bring my checkbook. I'm going to write a $10,000 check to join the club. And I got introduced into multifamily. I'm like, oh my God. What? I learned the wealth accelerator, what I call the magic formula, forced appreciation. You know, where $1 on a 6 cap is $17. $1 of NOI on a 5 cap.
Was this like a Dave Lindahl program, or what was it?
No, it was a group called Lifestyles Unlimited here in Houston.
Okay.
Been around for a long time.
Sure.
Way better. Dave Lindahl was actually a member of the club at one point.
Okay.
So I know he's got a great book.
You skipped the single family.
I skipped it.
And so what was your first deal?
It was with my partner. It was 238 units, roughly 40,000 a door.
Wow. You don't hear that every day. First deal, 238 units.
He was the GP.
And he had done it before.
This is a different time in the market.
Brand new for both you guys.
Yeah, he had done. He was from London.
Okay.
So he had a fancy British accent, like the gecko, the Geico gecko.
Yeah.
So a big panty dropper. This guy. He can like to get money from anybody, right? I was the Wizard of Oz behind the curtain. I was the sales guy with the local market knowledge. He was the front man, the showpiece. So he and I bought this deal. He raised all the equity. I didn't even get any of the GP split because back then it wasn't like that. I put my equity, and at my point, I put $200,000 in that first deal. I had a net worth of $800K. So I put 25% of my family's net worth in that deal. And I told my ex-wife now, I said, listen, I'm 32 years old.
What year is this?
This is 2007. So I'm 33 years old. And I said, that's all of the money to us. I'm going to walk for my day job. And I'm going to guard this with my life. Because I don't know what's going to happen. I need to make sure that money comes back. So she was like, I understand. Follow your heart. She was making great money too. So I was very fortunate that I had a supportive spouse. And so I went there and I hit it every single day. And I learned the business, which is what nobody does today. Everybody wants to syndicate. Everybody wants to just raise equity, keep whatever they're doing, think that it's going to be some magic ride. And it's not. You've got to get knee deep in the weeds and learn this business. And I'm very proud that I'm one of the few guys that can say that from 07, 08 doing that. But you know what's funny? That was a requirement in the club.
What was that?
You cannot raise equity and keep a day job. If you're going to raise equity to buy a deal, you must quit your day job and you need to work the deal.
I agree with that. Because at the end of the day, you're taking a slice of someone's hard-earned income and time that they're never going to get back. And so if you're not going to protect that with all of your time, how dare you take their money? And
so
that's kind
it
of
was the greatest foundation for me.
Mm-hmm.
It's what I give tremendous credit for, because if they, other programs, I know there's a great program up in Dallas that's having some issues right now, but they don't require that, And Dallas is a very financial company. There's a lot of smart guys there who don't want to walk away from their big financial jobs that they have, but want to raise equity, want to sell the dream. This real estate club was full of equity, full. So from 2000 so I raised my first deal in 2010. So from 2010 to 2019, I raised $90 million within the club. It was all 503B. Combination of
it was all from other members from the club.
From the club.
So you guys are writing each other checks, investing each other's deals.
I would get emails. This is legit. I would get emails every single day. Because once you have a track record, once you're known, once you present on the stage, because only members can present on these Friday road trips, or where we get on a big bus, but we only go to members deals. So you get the highlight. Hey, my name is Robert Martinez. I just bought this 129 unit deal. Let me show you what we've done. You do a lot of before and afters. You do the NOI, what the underwriting was, what your actual is. People are like, man, I want a piece of that, right? I would get no line, hand on the Bible. I would get emails every single day from somebody wanting to be in a deal, whether I had a deal or not.
And so were most of the members in this club wanting to be active, or they want to be passive, or both?
It really was 90-10.
90%
passive.
Wow.
10% I want to do this. This isn't the world. I'm an OG. It was the success that I had and the success of guys from that time that created the furor of activity today, where now everybody wants to be a syndicator. Right now, that wasn't like that. Remember, it's also coming off of the recession. People have lost a lot of money in the stock market. And so they were afraid. I had one of those who lost almost everything in the stock market, gave me pretty much his last $100,000, but he did it in 2010. I refinanced all of it out in less than 24 months. He bought another deal with 100% outs. That second deal, 2 years later, refinanced 100% out. He bought a third deal. He laddered to where his original $100,000, he owned 9 different deals at $100K each.
What do you think you've turned that initial $100K into over the years?
I would say there's no way that it's less than, 100K, 20X. There's no way.
So it's $2 million.
No less than $2 million.
What's the best deal you've ever done?
I sold a deal that I bought in 2012 And when I sold it in 2019, we made 900% return.
Wow. So what you
we
guys,
paid 24.5 for it, a door. So when he raised like, I don't know, 2 million or whatever, it wasn't a lot of money. And we sold it for like the better part of 90 a door later on. I bought another deal for 15,000 a door in 2011. I sold that one for 110 a door. So that one also was another 900% return. So I had 2 or 3 big deals. I have my original deal that I bought in 2010 for 24.5. I tried to sell it at the beginning of 22, not knowing what was going on, and didn't get any buyers on it because the market was going down. That should have returned 1,000%. We'll see what happens now. See, what's happened with all this, it's what I call the great reset. There is a reset of valuations.
well, cap rates were getting so damn low. And it was almost like the cap rates, whether it was C class, B class, A class, were almost on top of each other, which is why
sure.
I think a lot of people started, pivoting
Buying
over
the
the A.
yeah,
Might as well buy the new stuff if there's not much of a delta between C and A. So I get that. But
So the next question is, would I buy any more A's, right?
Yeah.
I think I've made my mark on B and C. I have one deal that I bought in A that we did a 60% return in 24 months, but I've never done a 100% return on an A deal. I think when it's time to go back, I can do B and C because there's more meat on the bone. I get that market. More importantly, the sentiment of the tenant base is more forgiving.
What do you mean when you say that?
Well, they will allow for more issues to occur from day to day than an A resident. An A resident will not renew. They will blow up your phone. They will blow up your internet. They will do everything, right? They won't stand for things that don't work right. Your B and C.
You're saying like they're more entitled.
Yes, that's the word. Thanks for finding that. Entitled. Your B and C are used to. They're more humble. They just want to be taken care of. So all my rehabs were never these big, Taj Mahal rehabs. I'm literally focusing on basic services. I change out 100% of the air conditions because as an operator, I know that the reason why people move out is maintenance. And in Houston, Texas, the number one maintenance headache is air conditions. So fix the air conditions, you fix a big part of your move out reasons. Number 2, hot water on demand. Sounds very simple. It's not. B and C, they're boilers. They're old boilers or they're individual water heaters. Change them all out. Never have an issue where basic services are a problem and you will increase your renewals. Then you try to make sure there's a culture that they understand people live here and they're going to experience their birthdays, their anniversaries, big life moments. What if your mom lived here? Treat it like your mom lives here. Treat it like somebody's having a birthday party this weekend and they're having people over. Do a quality make ready. And if there's an issue, make sure that you deal with the issue within 24 hours. Don't let it pick up. The other day when I took over the portfolio, we had one property that had 250 work orders.
This is from the third party?
Yeah. And it's a 276 unit deal, 300 work orders, and there's no way they're going to knock them out.
No.
That when there's that many work orders.
How do you catch up on that?
There's staffing issues with the manager, not enough maintenance, all kinds of stuff. We had credit holes because they weren't paying our bills. They were accruing it in the P&L, but they weren't paying the bill. So when we got all of our team together, we had a really good lead supervisor who said, okay, I'm going to take these 5 deals, these 5 lead managers, lead maintenance guys, and we're going to go help our sister out on a Saturday. And we're going to come in and you're going to take 50 work orders. You're going to take 50 work orders. I'm going to take 50 work orders and we're going to meet here at the end of the day. And that's the only way to take care of that because there's no way the in-house team, when new stuff's coming in, that they're going to take care of 300 work orders. You have to do it like the village approach. And once those are knocked out, then you got to make sure that your in-house maintenance guys can keep up with the current workload. If you start seeing it rise again, you got to examine why is there a problem? Is it a problem with the manager? Is there a problem with the maintenance? Is there a customer service issue? Where is the lack of urgency? Because somewhere there's a lack of urgency. And so that's what I mean. That as an independent owner, right, as an entrepreneur, it means more to you than anybody else. You sign on that dotted line. So while I'm so disappointed that I'm the last one that should have a bad mark on my record. I've been doing this for too long. I've had too great a track record, but it was a monster wake-up call. And Scott knows this. It elevated my expectations to a level that I don't think I've ever had before. But as you stopped me earlier, right? Mm-hmm. I'm so passionate about this now, and I really realize that I'm not going to bring down my standards for anyone. I won't. This is what it's going to take to be successful. Right now, moving forward, we've got to pull ourselves out of whatever has been occurring with the third party. We've got to start to rebuild our treasure chest of cash and our reserves. When they took over, I had 1 year of reserves in every one of my account that we had built away. That got decimated.
How many other properties do you have on floating rate debt right now?
So I had a total of 9.
Okay.
I had 2 that I put away. I had the one that just lost.
When you say you put away, you sold them?
No, we refinanced them.
Refinanced them in a fixed rate?
In February and March.
Okay.
Which is a lower rate than it is today.
Yeah.
I got 6 more now that we're in the process of. Some I just bought in 22. So I mean, I'm gonna have to wait. So I'm gonna have to do a cash in on a 2021 construction deal where we're gonna do a rate cap, and the investors are gonna have to wait 2 more years. But I've learned a lot from the deal I lost, so we're gonna put all the cash in. Other deals we've been working to stabilize them. Now we're at a point. So I think we'll be refinancing 3 to 4 in the next 90 days.
Okay.
Of the
into fixed rate debt.
Into fixed rate. And I don't have a choice. I can't play the game.
Yeah.
I think a bird in the hand is better than 2 in the bush.
Mm-hmm.
Because you may think, rates are going to come down. Where have you seen that rates are going to come down?
Well, we don't know. It's all speculation, right?
We don't know.
So, you hear some folks saying, hey, we're going to see a few cuts in 24 and maybe we'll see a few in 25, but that's speculation, right? Where do you see interest rates navigating over the next 24 months?
My buddy Grant said to me that rates are always come down before
He's
an
calling
election.
for 3% rates.
He is. He told me. I'm glad you said that. 3% rates. That's what he predicts that will happen by 2025. Now, Grant's in a lot of rooms that we are not in. And you have to understand, who are you talking to? Grant's a multi-billionaire. So he can pay for information. He can get the information. How come guys like, what's the old investor's name? I can't think of his name right now.
Warren Buffett?
Warren Buffett always seems to know what's going to happen because he helps make policy. Well, he talks to other people too. Who is Grant talking to find out what's going to happen? So he may be 3%. Maybe this pause is the beginning of the top of the cycle and coming down, but who really knows? There's an expression, survive to 25. And that's been going around for a while. Because if you hold on for 10 years, you'll not lose money in real estate. I've seen it happen. And you might even make 10x like I did on some of my deals. To give you an answer would be if I can guess, because I don't know. I can just tell you what other people are saying. Grant says they're going to come down. I hope, but I can't rely on that. How do I know that this war that's occurring right now doesn't stimulate something? Now, let's be honest, right? When there's a war, that's typically good for the economy. And maybe that's why our economy is very strong. Considering what the Fed's done, we're still at under 4% unemployment.
Shocking. Because, if I would have told you in early 22 that the rates would be where they are for the next 18 months and pricing relatively would not be changed, you probably think I'm crazy.
Well, anybody would. Whatever reason, we're at 3.5%, 4% inflation, whatever the number is.
Yeah.
That's still too much for the Fed, even though they said in the beginning it was transitory.
I'm good with 3.5% inflation.
Everybody is.
I think most real estate investors
Everybody,
are.
that's what they do. They're beating you down with that. We were good before all the things before COVID, and then COVID kicks in. So here's what I told Grant. Grant's been saying this, but he stole it from me. Inflation is the new COVID. And the new Fauci is Jeremy Powell. And higher interest rates is the vaccine. Tell me I'm wrong.
No, that's so good.
They did one big national world event, and they're doing a second one now. Who won the first time? Big Pharma. Who's winning now? The big banks. Who got pissed off with Donald Trump? Big Pharma and the banks.
That's an interesting take.
So I don't know what's going to happen. I don't even know if Trump's going to be able to run. I don't know if we're going to have an election, because they say if you're at war and all that, you shouldn't have an election, or you can't have an election. So I believe the war, I'm not saying it's manufactured, but I've been on this world almost 50 years. I see things. I have a mind. I can speak. I'm a free thinker. I don't think anything happens by coincidence. I think everything is by design. I think that you need a war to pull you out of recession. I think if the economy sputters, they have to bring rates down, which is what Grant.
They got a big lever to do that now. When rates were at zero, they had nowhere to go with them.
Well, they could have gone negative, which is what happened in Japan. That's what Grant said too.
And people were predicting that.
Yeah. So if you look at I have a chart that I always show my investors. of where rates are supposed to go and where they actually went, there's predictions all over the curve. And here's what they actually did, And so you really don't know.
But the inflation was not a surprise. Granted, they printed 50% of the currency in 18 months.
That's why it was
COVID.
so important.
So how was it a shock that inflation went to 9.5%?
People forget that. Smart people forget that. Yeah. It's never really, when's the last time that happened? Most people in the game today were not around in the market. They were still kids sucking on their thumb when that kind of stuff happened. That was in the 80s. That was right after the Iranian hostage thing, right? From Jimmy Carter. You probably don't even know all any of that. I mean, I remember all this. I was a young kid sucking on my thumb, but I didn't know of it, right? And so I think you need that war. You need to have this. The smart money bought everything they could. They should have bought it at fixed debt. You refinance. I have a bunch of deals that are super low, 3, 3.5, 4. Half my portfolio is under 4, is at 4.5 or less. The other half is over here, playing with a fixed rate debt. It's such a wide spread, right? So my personal house, I got it at 2.9. You think I'm ever leaving that motherfucker? No.
Yeah.
It's a multi-million-dollar mansion. I'm just gonna sit here and know that if I need the money for something, I can sell it because the equity's in it. It's already probably popped $1 million in equity because of what's happening. So now, what do we do now? You literally have to draw a line in the sand and say, I'm gonna be a buyer. I'm gonna hold because I think rates are.
Are you a buyer right now?
I am not, and I'm glad you asked that.
You guys aren't looking at deals?
No, not at all. My number one focus is for my investor. I got to fix my portfolio, and they asked me. It's funny. The craziest thing they asked me on the call.
What's the next opportunity?
When's the next opportunity? I'm like, I'm not looking right now because this is not the right time. The blood's not thick enough, right? There's plenty, but it's gonna get worse. If it's gonna happen to me, it's gonna happen to everybody, right? So, best operator wins, 100% of the time. So I think this has to cycle further. The pain's got to get a little thicker because think about it. Every time the rate goes up, that deal goes down in value because the cap rate has to move with it. If insurance stays up,
Dude, the insurance is another thing. The insurance kind of happened simultaneously with the interest rates. And it's not just in this market. It's all markets and it's all asset classes. The insurance is crazy right now.
But let's think about this too, right? What it affects these. So the insurance has had 2 big years where they've paid out more than any other time in history. Isn't there a lot of these once in a lifetime events occurring all at the same time? Like California had an earthquake and a hurricane at the same day. Hawaii looks like it went through an atomic blast. You have New York flooded. I was just there 2 weeks ago on vacation, and I was there for 5 days, and it rained 3.5 days. And when I came back, I didn't think anything of it because I don't like to watch the news. And I find out there's still flooding. There's still heavy rain. Like, these things don't happen. Remember seeing those pictures where the subway towers are popping and there's water coming out of the walls? Like, they've got to do remediation on that stuff. That's expensive. And that shit's old. And there's a lot of it. So are rates our property insurance going to come down? No. They're going to pop again. But what's going to happen, if you're a new buyer, this reminds me when I got in the market in 07, 08. I owned nothing, and I'm taking advantage of somebody else's misery. Those deals that I bought for $24,000 a door, $15,000 a door, were not bought at $24,000 a door and $15,000 a door. I bought them either from the lender or from the guy that had to get out, right? What's going to happen this time? Those deals, remember, if everything affects the NOI, so if insurance and taxes are up, NOI goes down. If rates aren't keeping up with expenses, NOI is down. If your debt service is so high, you're not making any cash flow.
And we're not seeing the organic rent growth that we were a few years ago.
No. So I think,
where does this bottom out?
Here's the thing. Why would you want to buy a new car today when you can buy it tomorrow for a used car price? That's exactly what's going to. You're going to buy a new car tomorrow at used car price.
I got a question for you. Multifamily cap rates were the lowest out of any commercial asset class over the last 5 years, and they kept compressing, and rightfully so. From a risk-adjusted return basis, multifamily is the safest asset class to park your money. And there's a reason why Fannie Freddie will give you non-recourse loans for multifamily and mobile home parks, and that's it. Mm-hmm. Because people will always need a place to stay. That's never going to go anywhere. But how much of the low cap rate environment in multifamily over the last 5 years was driven by all these multifamily educators on social media, all these masterminds that are teaching folks how to come in and syndicate off the couch? As
busy as you see, we have a very minute, the amount of transactions they get in nationally, very little by the one-off syndicator.
That's true.
Very little.
A lot of it's the hedge funds.
It's the hedge funds, the Blackstones. Now, are we getting our piece? Yes. Is it a huge piece? No. I would say, in my mind, it's got to be less than 10% of all national trends. I would even say it's less than 5% of all trends. That's why Grant likes to beat his chest and say, "Oh, I'm the biggest, independent operator," or whatever. But there's a lot of little bitty ones out there. I've been doing it for a while too, but we don't have that massive scale like a BlackRock that does. So I'm gonna take a step back. Where does this end? Who is the biggest buyer of homes right now?
Ooh, you tell me.
Investors.
Mm.
It's not people needing a house. It's investors. They're buying, I think I read somewhere, more than 50% of all
So
new
less
sales.
than 50% of single family homes in America, less than 50% are primary residences.
Correct.
I believe that.
They're being bought by investors. I think while BlackRock loses and gives back keys on some things, they're also at the same time raising the largest war chest to buy deals that they've ever had. Again, I'm a free thinker. I think there's a lot of things at work that we don't know. I think this is the wiping of the board, destroying the middle class. You're going to get the rich going to get even richer, and the poor are going to get poorer. I personally have taken a massive hit in my net worth because of what's going on. I can fix it, I can build it, but it doesn't help me every time insurance and all that go up. I will lose investor sentiment. BlackRock and those guys can raise billions, and they don't care because BlackRock, they have such a huge thing. They will go
and their
buy
cost
that
of
deal.
capital is a lot lower
That's
than
what I mean.
us individual investors.
That's what I
a
mean.
lot lower.
They're going to take that and they're going to buy. So I'm saying deals are going to be bought more and more by private wealth, and it's going to be less for us. For sure.
Unfortunately,
it's wiping the board. It really is.
Because they just need single digit returns.
That's right.
Right.
That's right.
And our cost of capital, it really is 14% plus. Right. That's the expectation. That's the appetite.
And who's their business? Their businesses are these foundations: Harvard Foundation, UT, University of Texas Foundation, Texas A&M's Foundation. They all put a bunch of money. That whatever teachers union out of California or the subway union in New York, they're all giving these big players money. Have you ever watched Billions, like the TV show Billions?
No.
Oh, bro, I just found your show, Axe Capital.
Okay.
Go watch the actor in his company, Axe Capital. That's who all his guys are. And they pay for information. They're market movers. There's an expression, "Hey, is this something we should do?" And the guy gets a little wink. He goes, "I'm not uncertain with the information that I gave you." Meaning that, hey, I did something. I killed all those chickens. It's going to cause, or I put a virus in the chickens. It's going to cause a chicken issue. So we need to get into, shorting chickens. Like, there's a lot of cuckoo, crazy stuff going on. So I may sound like a tinfoil hat kind of guy right now, but I don't believe in coincidences. I don't believe the Fed's popping rates. I don't believe in COVID at the same time. I don't believe in insurance getting destroyed, because we've had more once in a long. Houston, Texas had back-to-back freezes, which you saw.
I did see that, yeah.
Where I had to move out of my house for a week because my pipes popped. Anything I had exposed outside, which I have a really nice backyard, there's piping that goes there to get to the water that's in the barbecue area, right? That popped. And when that popped, I had no water in the house. I had to get it fixed. I had to go stay in a hotel. That's how cold it got. We're not used to that. And it happened again the next year.
What do you say to the folks out there that are saying, hey, we got an election year next year. Inflation's back down into threes. Soon it's going to be 2.5. The Fed's going to start tapering rates back, and we're going to have a soft landing. Would you be shocked if that happened?
Extremely shocked.
Yeah. What are you telling new multifamily investors today? Are you saying if you find the right deal, go for it?
No.
What are you telling them?
I'm telling hey, what is insurance going to be next year? If you closing that deal today, great. You're buying it at 6 cap, or you're buying it, okay, but you're still at a 6. But it will be worth less tomorrow if insurance rates go up again. I've never seen insurance rates go up. Insurance is going up so fast that rent cannot keep up with it. So why are you going to go in there until things when things aren't even stabilized? Things aren't stabilized. I don't need to buy at the low. I can buy on the way back up. I've seen the way back up. There's plenty of time. So until insurance stabilizes, until rates stabilize, I'm not a buyer. I won't take that risk. Why should I? I don't control it. When I see natural disasters slow down, I will do that. And I have not seen that. It's sped up, Rich.
Mm-hmm. No, for sure. And I agree with that. And that's part of the reason, like for us, I'm not buying the single family short-term rentals. I'm not buying anything turnkey and multifamily right now because of the competition. It's really hard to find those substantial discounts, right? Even in this economy. And so right now we're buying boutique hotels, 10 million and under, because of all the mom and pop sellers, the boomers that are retiring.
Yeah.
And we can go in there and buy these things at a tremendous discount.
And this in California?
But, we're looking primarily California, but a lot of coastal stuff. But the only way we're able to make these deals happen right now is I need two things. One, I need to be able to buy it at a tremendous discount, and I need to be able to add a tremendous value, at least 2x the value of the property in the next 12 months.
Mm-hmm.
And from what I'm seeing, the only way to do that right now is in this climate is these boutique hotels by mom and pop sellers and buying deals where we can build ADUs in expensive neighborhoods such as San Diego, Orange County, that kind of stuff. But the multifamily stuff, office space, a lot of these other asset classes that institutional money buys, you're not going to be able to 2-3x the value of these properties right now in this climate. So I'm kind of with you there, and I'm interested to kind of see where things navigate, man.
It's hard to buy in the coastal areas right now.
Mm-hmm.
I've got students of mine. We're going to be on a call hopefully soon together. You're going to jump on with me.
I'm excited for that.
They buy in the Midwest. They buy in the Northeast. Their insurance is not popping the way mine is. And I did not know that. I thought this was a national issue. They're like, no, bro, we're still getting $500-$600. What? You're getting what? I'm like $1,600. I know it's going to climb to $2,000 next year. How are you at? But they don't. It's a different pool, So that would be the only tinker I think to your strategy. Maybe is like find out where insurance is the cheapest, where it's still stable. Then you can hit those returns, right? But right now it's hard. I got to see insurance slow down.
I got one final question for you. So you said multiple times survive till 25.
Yeah.
Where are we going to see the multifamily climate in 2025?
I think there's going to be massive demand. I think everything's going to shoot in value once those cap rates come back down. There has been a decrease in shortage, right now. A decrease in construction. Everything's going to be worth more. I talk to brokers all the time. I was having lunch with one last Thursday before I left out of town. He's of all, you see those listings coming around every day on your inbox?
Yeah.
How many of those do you think actually make it to the finish?
Not a lot.
Less than 10%. So whatever you see in
I'm
email,
looking at the pricing guidances. I'm like, these don't even make sense.
People are having to ask for what they can get and find stupid money. I was with two of the most reputable brokers in this town, and one said their deals were off by 83%. Another guy said 90%. They're off. That's how far they off transactions. So I said to him, when I see these emails coming around, how many close? He goes, probably about 10%. And I'm like, so am I correct to not buy? Yeah, I'm not the only one that's seen the same thing. I've been doing this long enough. A new guy may not see that. So when my students are looking at deals, I'm like, where is it at? Let's underwrite it together. Let's make sure we're on the same page, because I don't want to see you get into a bad deal that's worth less tomorrow.
I love that. Well, my man, it's been a pleasure, dude. I appreciate you taking the time to come on and did your stories. I can just tell how passionate you are about everything, and I have no doubt that you're going to get through this.
Yep. And
we're gonna see this next upside and this next run. And I'm excited to get you back on the podcast, maybe 2025.
I will be there, man. And thank you so much for taking the time to come all the way from San Diego to Houston and hang out with me just to hear our story and visit with us. It means the world to me. I would definitely return that favor. I'll definitely go back out there, man. But thank you. It's an absolute honor for me.
Yeah, we'll have you out in San Diego next time.
Let's go, baby. Thank you.
I appreciate you, my man. Listeners, thanks for tuning in. We'll see you in the next one. Peace.